Hey everyone, welcome back to the channel. Today we're diving into one of the most talked about indicators in the financial markets, the VIX, also known as the volatility index. If you've been following the markets, you've probably heard of it, but you might not fully understand what it is for or how it can impact your trades. Well, don't worry, because by the end of this video, you'll have a comprehensive understanding of the VIX and how it can be a valuable tool in your trading strategy. And of course, we'll take a look at the current VIX levels and see what they tell us about the market today. All right, let's start with the basics. The VIX, or volatility index, is a market index that measures the market's expectation of future volatility based on the options pricing of the S&P 500 index. In simpler terms, it tells us how volatile the market is expected to be over the next 30 days. It's often referred to as the fear gauge because historically, it tends to rise when there's fear in the market and falls when the market is calm. The VIX is calculated using the implied volatility of options on the S&P 500, which reflects how much traders think the index will move in the near future. The higher the implied volatility, the more expensive options are, and the higher the VIX will be. Now, the VIX calculation is actually pretty complex, and it's based on a weighted average of the implied volatilities of a range of S&P 500 options. But don't worry, I won't bore you with the heavy math. The important thing to understand is that the VIX doesn't predict the direction of the market. It only measures the expected magnitude of price movements. So a VIX of 20 means that the market expects a 20% annualized movement in the S&P 500 up or down over the next 30 days. Let's talk about how to interpret VIX levels. A low VIX, say below 15, indicates that the market is calm and that investors are not expecting much volatility. This usually occurs during periods of stability or bullish trends. Conversely, when the VIX spikes, it typically indicates that the market is expecting large price swings, often due to fear, uncertainty, or an impending crisis. For instance, during a market crash, the VIX can soar above 40 or even 50, signaling heightened anxiety. On the other hand, when the VIX drops below 10, it's often a sign of extreme complacency, where investors might not be pricing in any potential risk at all. So the VIX can be a helpful tool in gauging market sentiment. Let's take a quick look at the VIX chart representing that, right? So on this date, if we go back looking at this live chart on Monday, August 5th, 2024, let's see what ES did on the 5th of August. February. So there's this big drop on the daily. You see it right here. And down here on this drop, we can see that there was a spike in the VIX, drop in the market. And my neighbor's really blasting this music in the middle of the day, huh? Now let's discuss the relationship between the VIX and market sentiment. When the VIX rises, it's often a sign that investors are nervous about the future and expect significant market fluctuations. This usually happens during times of uncertainty like geopolitical tensions, economic downturns, or unexpected financial news. On the flip side, when the VIX is low, it reflects an environment of confidence where investors aren't anticipating much risk in the near future. Think about when those two cases often arise. It's important to note that the VIX and the market tend to have an inverse relationship. As the VIX rises, the S&P 500 often falls. And when the VIX falls, the S&P 500 tends to rise. This inverse correlation isn't always perfect, but it's a general trend you'll notice. So again, talking about that, I want to tie this into the example. We just saw this. The VIX spiked on this day, and we can actually go to the 4-hour. Then we'll go to August 24th, 2024, or sorry, August 5th, 2024. Go to that date, there's a spike, and we'll go to the same day on ES, August 5th. And we can see here that as the VIX spiked, the market sold off. As there was an increase in fear, uncertainty in the market, okay, the VIX spiked, the market was selling off. You'll see that time and time again, guys. Now let's talk about how the VIX affects intraday swings, particularly in the futures markets like the E-mini S&P 500 ES, the NASDAQ 100 NQ, and gold GC. These markets are heavily influenced by shifts in volatility, and understanding how the VIX can guide your intraday trading decisions is key. When the VIX spikes, and we just talked about this, it often signals that we're in a period of increased volatility. This means that futures like ES, NQ, and gold could experience wider price swings throughout the intraday. For example, during periods of high volatility, you may see larger intraday moves in the ES, which tracks the S&P 500. These movements can be fast and sharp, guys, making it a great time for day traders to capitalize on short-term price action, but also a riskier environment. Exact same example, right? So if you're looking at the VIX and you're doing TA on the VIX, Okay, and one of the things that we like to do is we like to look at the VIX really on the daily chart, right? So we'll come back up to the intraday and we'll draw pivots on the VIX, right, on the daily chart. And these daily pivots, right, where there's previous support and resistance, can tell us where the VIX might pivot. And if the VIX is going to pivot down, knowing that it is the inverse of the market, then we might have an up day in the market. Same with if we think that the VIX is going to pivot up, an increase in volatility based off of it hitting some pivot point, then we might experience a very fast sell-off. Because again, the VIX is inverse of the market, but an increased VIX also is just increased volatility. Higher volatility is faster candles. Keep that in mind. It's all correlated together. The market grinds up and it sells off, falls off a cliff. So you get that increased intraday range when the VIX is high. You can expect the range of price movements in all futures to be larger. For instance, a high VIX could mean that the NQ can see larger daily swings in both directions. Okay, these are often signs of fear or uncertainty in the market, and they can create opportunities for volatility-based strategies. But you have to be careful, guys. Okay, wider ranges also mean more risk. The same leverage will lose you more money or make you more money. It also gives you faster reaction to news. Okay, a high VIX typically means that the market participants are more reactive to news or economic data releases. For example, the VIX jumps higher after an earnings report or a Federal Reserve announcement. The futures, like the ES, might move rapidly, reflecting investor uncertainty. A sudden move in the ES can open up trading opportunities for short-term traders, but you need to be prepared for fast reversals. Again, high VIX means high volatility. Volatility is this. Low VIX is going to give you narrower price action. So on the flip side, when the VIX is low, the market generally experiences more stable conditions with smaller price swings. Such a low volatility environment, intraday movements in futures like the ES or NQ tend to be more gradual, which may present fewer opportunities for you, the trader, when you're looking for those quick scalps and moves. But it can also be an ideal environment for trend following strategies since price movements tend to be more predictable. So there's that trade-off there. Volume and liquidity impacts, right, of note when you're measuring the VIX. So some other things around volume and liquidity. It's also worth noting that volatility, as measured by the VIX, can impact volume and liquidity directly. All right, when the VIX rises, trading volume in futures markets often increases as traders hedge or enter new positions based on market sentiment. This could lead to greater liquidity and potentially better fills for intraday trades, but also a greater chance of slippage during periods of extreme volatility. And you probably have some events that you're thinking of that exactly relates to. So when you're monitoring the VIX for intraday trading, you want to pay attention to not only the current level, but also the trend in volatility. Do that TA. A rising VIX during the day might signal that it's time to adjust your trading strategy to account for more volatility, while a falling VIX can indicate that the market is settling down and the price action will likely become more stable very, very shortly. All right, so let's take a look at the current VIX levels based off of what we learned so far. Okay, the market, we had a red day this last Friday. It's currently January 12th, and we had an up day on the VIX. So everything that you've learned in this video is this day, really every day, is a really good example of how this works. A big pop-up, right? The VIX went from 18 up almost 2 points, or actually did go up 2 points here, up to 2.3 points, up to 2033, and then it came off a little bit. And on Friday, okay, we had this double doji continuation pattern, but we had a nice red day into a volume shelf that is down here. Okay, if I turn on my visible range volume profile, we're gonna see that there was a shelf here, but also it gave us that nice down day. So this is another layer of analysis that you could add in. Overall though, if we just look at the number, the actual number of the VIX, and what are some other VIX numbers that have appeared? Okay, so we know that the market has been as low as 11, and we're currently up at 1953. So the VIX is pretty volatile compared to, you know, the absolute low. We can see here that the VIX has had some pretty crazy high highs. And a very simple way to understand the impact of the VIX at any current price is to just go and explore price action and the daily ranges at certain VIX levels. So the VIX is certainly right now in an elevated state. And so as we're trading in the markets, guys, remember this inverse relationship, but also remember that the actual value of the VIX itself is really important in understanding or mapping out your expectations for the next trading range. Okay, if the VIX drops down to 10, we're not gonna have 800-point days. We've had some 800-point days in the last few months in NQ. That's not gonna happen in a low volatile environment. It just won't happen, okay? Now, in an elevated VIX environment, we absolutely can. On any given day, we can get a spike, right? And we'll have those really, really big days. So just keep that in mind, especially with the current levels. And we've been ranging around in these levels. It looks like the VIX has a little bit of an uptrend right now, so volatility is increasing, right? What would you expect? As if the VIX is gonna keep increasing, you should expect the daily range to keep expanding, okay, on ES and NQ, and keep that into account when you're doing your trade planning. Here's another example of that. So during the 2008 financial crisis, the VIX reached an all-time high of over 89 points, signaling extreme panic. More recently, during the COVID-19 market crash in 2020, the VIX spiked above 80. Comparing today's levels to these historical spikes can help us understand whether the current market sentiment is relatively calm or if we should expect more volatility ahead. So you should be looking at the VIX every single day, or at least on a weekly basis. So how can we use the VIX in our trading? First, you should know that the VIX itself is not directly tradable, but there are a variety of financial products that track the VIX, including VIX Futures, there are VIX options, and VIX ETFs. These products can help traders capitalize on changes in the market. So that analysis isn't just used for your futures trading. You could also trade other things. As prop traders, obviously, we just want to track it for our prop trading. Here are a few ways you can use the VIX in your trading strategy overall. So hedging, if you're holding long positions and the VIX starts to spike, could signal increased market volatility, and you might want to hedge your positions by buying put options or inverse ETFs to protect yourself. Number 2, volatility trading. If you believe that the volatility is about to rise, you could trade VIX futures or buy ETFs, like the ProShares VIX Short-Term Futures ETF, VIXY. You can also use it as a contrarian indicator. When the VIX is extremely high, it is a signal that fear is overblown and the market could be due for a bounce. Conversely, when the VIX is very low, it could indicate excessive optimism and potential for a market correction. The fourth way you can use the VIX, okay, intraday scalping and trend following. Pay close attention to the VIX to determine the speed and size of your trades. When volatility is high, look for larger price swings to capitalize on intraday moves. When the volatility is low, you may want to adjust your risk management to accommodate for slower price action. So what are some limitations of the VIX? While the VIX is a powerful tool, there are a few things to keep in mind. One, it's a lagging indicator. The VIX doesn't predict where the market is headed. It just reflects what traders are expecting. Okay, keep this in mind. Short-term focus. The VIX measures volatility over the next 30 days. So it's a short-term indicator. It's not great for forecasting, long-term market trends. Okay, VIX spikes can be temporary. Just because the VIX spikes doesn't mean that the market will immediately drop. Sometimes spikes in the VIX are just short-term reactions to events like news, and the market may recover quickly. Also, the VIX can rise and the market can increase. The VIX is just a measure of expected volatility over 30 days. That inverse correlation isn't 100% of the time. So keep that in mind when you're doing your analysis. There you have it. That's a comprehensive overview of the VIX, whether you're using it to gauge market sentiment, plan your trades, or hedge against volatility. The VIX is an essential tool for every trader looking to understand the dynamics of market risk. And if you're trading intraday futures like ES, NQ, or gold, or any of the other ones that we make available, paying attention to the VIX can help you anticipate and react to market swings much more effectively. If you found this video helpful, make sure to give it a thumbs up and subscribe if you haven't already. Leave any comments or questions down below and I'll be sure to answer them as soon as I can. Let me know what videos you'd like to see. Thanks for watching and I'll see you in the next one. Peace.